Good evening, everyone. Time for another silver update. This is the gold chart, and it's the 5-minute gold provided by netdania.com. You can click on the link below. I've drawn a number of trend lines in here. One of the things you get when you have this sort of violent paper sell-off sort of thing is that your trend lines start to become very erratic, so it's very hard to make predictions based on the trend lines. I've drawn them in here. The low is at this bottom. The next trend line tags this bottom and really doesn't have any other places it meets. The next trend line goes to this bottom and it goes through this area and it doesn't have much. And then the highest one intersects here at a higher point, meets this one and meets this one. So that establishes this trend channel that we're on. You can see we broke above it, touched it, went below it, and rallied a little bit, and then dramatically dropped off, and then came right back up to this trend channel. So this trend channel is the main trend channel. You've got to try to sort out the noise. That's one of the things you're going to see, as James Sinclair has predicted. You're going to see a lot of increased volatility as this thing works itself out. So the price that we had here at 1707, and then we had the drop off, we went down to about 1677. So you're talking about a $30 down move in gold, and then you had a rally here all the way up, so $30 down move, and then about a $35 to $40 up move. So a lot of volatility going on in the markets. We want to jump over and look at the silver. Same sort of pattern we had in the silver. We had a news-induced sell-off in the morning and then a news-induced rally. This has to do with the different indicators that they're reporting. You can see that we're just rounding up now on the MACD, so we may be looking at a rally over the longer term. Of course, on the weekly chart, we're watching very closely the MACD behavior. We're trying to determine if the MACD is going to behave as it did in the 2008 low, where it hit the zero line and started to round off and then rise at a lower rate. You can see the price was fairly steady, even though the MACD started to round off. So the question is going to be, are we going to have the same sort of thing with the MACD and hit that zero line and then round off to a more reasonable rate of ascension, or are we going to break right through and keep going up? So the two bottom spikes are holding. They're fairly strong, even though we've had a little bit of a bounce. So we're just going to have to keep an eye on that and see how that long-term picture shapes up. The other chart we've been watching very closely is the Japanese yen, the dollar yen cross. You can see that this morning we had a very important breakout. Actually, we need to pull back to the 10-minute maybe to get that, or actually we want to go out to about the 30. And you can see that we had this rising line here, but mainly this flat line. We can draw it flat because it's pretty much a flat top. And then we had this very strong breakout in the dollar against the yen. The Bank of Japan continues to print money to support the dollar, to support the current paradigm. We're going to talk about that when we get to the main story, when we talk about Jim Willie. The other chart we want to look at is the euro, and we had been experiencing a fairly serious decline in the euro, and then we had a little bit of a rally, and then today we just took that down again. The silver and the gold have been trading almost in lockstep with the situation in the euro. So as the dollar strengthens against the euro, the metals weaken, and as the euro strengthens against the dollar, the metals strengthen. So the last chart we want to look at is the crude oil, and the crude oil had a very nice rally to a top back around the 23rd, and it was falling off until we got kind of a fire-based, war news-based spike, and we touched up to that 110, and now we're falling off and then starting to rally. So on the long view, the really long view on oil, it seems that we have broken above the resistance of 110, and we're trying to churn and determine the next main target is going to be this 115 level. And if we can get through that 115 level, then we could have a serious race to these old highs. If you've watched the price at the pump, we're bouncing between 350 as a low and 390 as a high for a gallon of gas. I think that the $4 gallon of gas is going to be really a critical point where we will begin to see the type of economic contraction that we saw back in 2008, where the price is so high that the inflation feeds back into the loop and the price of other things start to rise. So let's jump over to Jim Willie. That's going to be the main thing I'm going to cover because Jim Willie does such an excellent job of summarizing things. I'm going to read the pertinent parts of this. The entire thing I'll link, but I want to read some of this to you and comment. End of equilibrium market forces. Even U.S. Fed members notice that financial markets are being rigged. The phenomenon is obvious to anyone with an above-average financial IQ. To point a finger at regular 10 a.m. and 3 p.m. stock market recoveries should include a mention of the Working Group for Financial Markets. This is otherwise known as the Plunge Protection Team. It never does in the media reports. The U.S. economy is stuck in the worst and most destructive recession in modern history, yet PE ratios remain robust. The bond market is the toy of the U.S. Fed itself, propped by trillions in purchases. The U.S. Fed purchases at least 75 to 80% of all U.S. Treasury offerings. The Operation Twist has been stripped of its fig leaves. The dollar swap facilities are merely QE programs with a beard. The fact that the bond market has few, if any, buyers should be the main story. Sadly, the U.S. government requires a weak economy in order to create more bond demand. Another vicious cycle is at work. The market mavens tend to cheer for interventions even though the integrity of the markets themselves is fast draining into the sewer pipes. The mavens cheer at U.S. Fed bond purchases for its liquidity infusion without much awareness of the absence of legitimate money. The U.S. Fed has become the quasi-banking system ever since the subprime mortgage mess hit, ever since the commercial paper market dried up. Yet it is failing. The indirect consequence of 0% money is distorted asset prices and extreme distortion of financial markets, all of them. The stock market is intervened upon. The bond market is directly controlled. The currency market is managed by the Exchange Stabilization Fund, which never receives press attention. The crude oil market is a vast playground, like when the Strategic Petroleum Reserve is released, or when the Gulf of Mexico is shut down, or the Keystone Pipeline is rejected. The Brent versus West Texas oil price spread has gone to $18 again. The grain market is twisted by wrong U.S. silo inventory data. No end in sight to muddy financial markets. The housing market is one of the most difficult to doctor, but even it has a vast hidden inventory held by banks. Teetering petrodollar standard. The Iran sanctions have undercut the U.S. dollar more than any other single item. The petrodollar is at risk. Many times in my articles, a warning has been scribed that the dollar kill switch is ready on the wall, fully constructed, awaiting word to flip the switch. Someday, in the not too distant future, the Saudis will announce acceptance of non-US dollar payments. Remember the movie Rollover? They have already made the supporting decisions towards this highly important step related to Persian Gulf security enforcement. The numerous bilateral oil trade deals with Iran have become an epidemic that infects the US dollar in its unilateral dominance for trade settlement. One big reason Saddam Hussein was removed was his decision to accept euro payments for crude oil. Another was to steal his gold, just like what happened in Libya, and might I add, what happened in Greece. Another was to abrogate oil contracts made between Iraq and Russia, as well as between Iraq and China. So as the many bilateral deals are struck with Iran, the US dollar foundation in trade settlement is crumbling. In parallel to the sovereign debt crumbling, see PIG's debt. In parallel to the U.S. Treasury bond crumbling, see foreign creditor departures. The bunker busters might drop, but the real damage is to the stable catbird seat for the U.S. dollar itself in trade settlement. Such trade is conducted less and less in U.S. dollar terms. Asia and the Middle East are leading the movement away from the U.S. dollar. Global U.S. dollar revolt. The developing nations of the world are in revolt against the U.S. dollar. They see no future in holding U.S. dollar-based bonds in reserve. They see no future in accepting U.S. dollar payments for their raw commodities and finished products. The secondary central banks of the world are increasingly stocking up on gold bullion and less on U.S. T-bonds. Some are actively converting from paper reserves to gold assets, like China and Russia. Many others are following their important lead. A more recent development has the BRIC nations blocking the IMF. They are cooperating less in Brazil, Russia, India, and China. Now that's very important because a lot of people talk about the IMF and its special drawing rights and their attempt to create some type of hybrid currency. Now, the IMF is primarily a U.S. organization. It was created by the United States. It's funded by the United States. Its residence is in the United States. So this is primarily a U.S. organization whose purpose is to pretend to be an international organization, but it's not. It's a U.S. international organization. The concept of the Chinese yuan is being pushed, like in compromise, which includes a greater voice of the East and a smaller voice of the West, in particular the United States. The gold price will continue to benefit as long as the global revolt continues against the U.S. dollar. Barter system coming. The current system must be replaced. Watch for signs of a vast, comprehensive barter system with wide participation. It will involve deals between nations at the highest levels. It will involve deals between corporations at the middle levels. It will involve deals with individuals at the lower retail levels. It will be more fair. It will relegate banks to utilities, a much more useful function. It will lock up deadbeat nations that attempt to take in valuable products in return for toilet paper that accumulates in a rancid pile subject to acidic decay. The new barter system must have a financial core in order to handle the short-term transactions and payments required. That core will be gold-based. The United States will not be at the center of this new system. In fact, the U.S. risks being shut out if it does begin soon to join the movement. Being an outsider nation looking in will result in high price inflation and more rampant shortages. Demand for gold will rise as the new system falls into place. The system has been endorsed and put in the implementation stage by Germany, Russia, China, and the Persian Gulf. The trigger for launching the barter system, so told to the Jackass by one of its participating architects and engineers, is the broad perception that the current system has collapsed. That day is nigh. So, excellent summary by Jim Willie at the Golden Jackass. He's been spot on for a very, very long time. Now, I've contended for quite a while that the drama that is played out will go out to the long-term chart. The drama that has played out here in the US dollar euro, and we'll draw this way, and the drama that has played out in the US dollar yen is really just a distraction. As I've said before, the 8 billion ton elephant in the room is U.S. insolvency. The U.S. has actively used everything in its bag of tricks to point all of the attention by offering a shiny object of Greece or Japan or China. The U.S. is constantly trying to deflect attention over to these other nations to keep the attention from being concentrated on the United States, which is the most insolvent nation on the face of the earth, in my opinion, and the international currency that all nations are required to trade in. So the main story for the next 10 years at least is going to be the coming bankruptcy of the U.S. international dollar system and the emergence of a new system. Some have speculated it will be gold-backed. Some have speculated it will be special drawing rights. No one really knows what it's going to be, but the end of the U.S.-dominated trade system is nigh, and that is a good reason why you should stack physical gold and silver, because when the new system comes into place, you're going to want to have an asset that maintains its value through the transition. And we'll talk to you next time.